is if it's stage 1, so right now we're in year 0. So if it's stage 1, you book a loss of 682 if you're at year 0. But if it's in stage 2 or 3, you book the entire loss, which is 8841. So there's a huge difference, right, between stage 1 and stage 2. So in the Western environment, where the banking regulator didn't dictate those thresholds, this is a big area. Because if you make stage 1 bigger, your loss is a lot smaller. In my example here, it's the difference between 680 and 8841. It's a huge difference. Now think about this. The purpose of IFRS is to give information to investors, right? So if you tell an investor, listen, here's what we did. We booked the loss that relates to a default of next year, but if it relates to a default over next year, we ignored it. And that's how we got 682. Would the average investor have a clue what you're talking about? Or would they say, oh, that's just an accounting number. I have no idea what they're talking about. Doesn't it sound really strange? If you want to talk about common sense, is there any common sense here? Now, why do they do this? Why do we have stage 1? Remember? Why did I say we have stage 1? Don't hide now. You forgot. You were sleeping? Why do we have stage 1? That's not why. Do you remember why? No, but why? I'm not asking for the calculation. I'm saying why. Why on earth do we do this?
Because that good exposures can turn risky in the future.
That's not why.
To reduce the level of uncertainty.
No, but why have stage 1, stage 2, stage 3? Why? No, but why have stage 1? What's the whole point of this? I spoke about it earlier at the very beginning of this section. The reason why is because the good stuff is super difficult to estimate, right? And because the good stuff is super difficult to estimate, the safest thing we can do as a standard setters is this number is probably much more accurate than the final number, right? The 12-month loss is more reliable because it's not that far out. So the argument is the Americans have a different view. The argument is, gosh, we're going to book expected losses. We don't want too much manipulation. So to prevent manipulation, we're going to come up with a formula that says the loss that you're going to book is limited to the amount that is somewhat trustworthy. Because the argument is the loss between year 2 and 10, the further out you go, the less reliable, right? So remember I spoke about, in my very first example, the issue with ECL is manipulation. So the solution the ISB people came up with, this is harder to manipulate because it's only 12 months, and that's not that hard to estimate like it is for 10 years. That's why. The Americans said, this is silly. The Americans said, do the whole lifetime losses. But the ISB said, hold on, if you do whole lifetime losses, we're worried about manipulation. So the Americans say, and I'm not saying it's correct, there are two different views. The American perspective is our auditors and regulators could manage this risk. The ISB is saying, no, we want to limit the loss because we think that risk is hard to manage. Time will tell. I personally think there's going to be a lot more scandals in the U.S. because if you have a lifetime loss on a longer loan, there's a lot of subjectivity. Now, which one's correct? I don't have a clue. There are new things. Anyways, the U.S. one is not finalized yet. It's next year. So.
The pricing of the loans as well.
Mhm.
built in the entire loss into the price of the product
Correct.
on day one. So you'll be charging higher from the US-based customer.
Well, technically, if you have a good management accounting system, it should be the same.
Again,
Technically, right? Practically, let's see. Is this spreadsheet clear? Because this is the whole concepts of how we deal with impairment. Now, is that perfectly clear? Now, the next topic is called stage. Yes.
Are we supposed to book ECL for all the financial instruments?
Yes. Well, yes. There's exceptions on how to do it for trade receivables, which I'll come on to. Which I'll come on to a little bit later. Let me do that now, actually. Okay. I'm just going to flip forward a few slides to talk about the exceptions. All right? So, if you're Coca-Cola, if you're Honda, and if you make sales and they're under the scope of IFRS 15, and the time horizon is less than a year, there is no stage one. There is no stage one. So, for a company like Coca-Cola or Honda, the staging stuff is irrelevant. Thank God, right? Because all we care about is lifetime losses. So it's mandatory if you don't have significant financing. Significant financing is defined in IFRS as 1 year or less, is not significant. So in IAS 39, they never defined significant. In IFRS 9, they do 1 year. More than 1 year is significant. So if you're Honda or if you're IBM and you sell computers and you give your clients credit and the credit is more than a year, you have a choice. You can do stage 1, stage 2, stage 3, or you can simply do stage 2 and stage 3. I can't imagine someone doing stage 1, 2, and 3. Do you have any examples of that with your clients? I think everybody I've worked with would never want to do stage 1 unless they have to, which is the bank. So you would probably say forget staging, stage 2 and 3, which is easy. Stage 3 means it's impaired. Stage 2 means it's not impaired or underperforming.
how do these companies define significant increase in credit risk?
They don't. In other words, they split it between default and not default, performing, non-performing. 2 categories. That's it.
So 2 means they...
Performing means stage 2.
Correct. 1 and 2.
Yes.
They combine stage 1 and 2. They don't have to bifurcate them. They only have to show the non-performing one separate. So much easier. So in the simplified model, what has changed? So in IAS 39, if you've done your age analysis, what we used to do, if it's in the current category, we would say there's no allowance required. Under IFRS 9, what we need to now do is make an ECL provision not just for the past due, but for the current category. Okay, so this is what's new. Now, I was doing some work with the hospital, and we need to make clear what is a credit loss. Okay, so what is a credit loss? So we have a credit loss, and we have a price concession. So this gets tricky. So, broadly speaking, you're having trouble paying, I call you on the phone, I give you a little bit of a discount and you pay. Is that a price concession? Probably not. Because I gave you a discount because you're having trouble paying me. Therefore, that's part of the ECL. So, second scenario, I was doing some work on some hospitals. The way it works with hospitals, I'm not sure how it works here, but the United States is even worse. But the way it works in the Middle East is the hospital, you go to the hospital with an insurance. The hospital invoices the insurance company, say $100 for your 100 rupees for your procedure. The insurance company says, oh, we're not going to pay that. They'll pay 50. And then the hospital has a meeting with the insurance company, and they eventually get 70. So in the hospital area, it's really messy because the amount you invoice, you never get paid. And they always have this argument. Well, what we're required to do is to split the loss between ECL and price concession. You cannot just assume the entire loss is a price concession. So, what? Yes?
If the realization of some amount is uncertain at the initial recognition, shouldn't we reduce the revenue rather than we record the expenses?
Correct. Correct. But the way it works is you don't book revenue for the entire amount. You have to book revenue on the expected realization.
Yes. Then in that case, we will not be expected credit. We will not be estimating expected credit losses or something.
Price concessions will be directly adjusted from revenue.
Correct. Well, correct. The point is the price concession is from revenue. The ECL is not from revenue. These are messy. So what the hospital I worked with did is they looked at the credit ratings, because there has been defaults of insurance companies in Saudi Arabia. There was one default about 6 or 7 years ago. So what they did is they said, okay, here's the credit ratings. These credit ratings relate to these default rates. This amount of the receivable goes to the ECL model. And the balance is a price concession. It was a messy one because hospitals is one of those industries where the invoice that you issue, you never expect to get paid that amount. It's a different industry, right? Someone is in a hospital here, right? Wasn't there? The same in Pakistan?
I don't think it's the same here.
Okay. All right, well, you're lucky. You're more organized. I mean, in the U.S., because my business in India, we do collections for U.S. doctors amongst many different fields. A doctor might invoice $100,000 for a procedure, and they might settle for $5,000. Sometimes they get $10,000. Sometimes they get $15,000. So really, the price you ask and what you get and how you negotiate, there's a huge, huge range. In Saudi, the range wasn't as big as America. It was a smaller range, but it could still be 20, 30%. So the key thing here is we have to distinguish between a price concession and a bad debt. So if a customer calls up and says, I'm angry, the goods were late, the paint is chipping, there's a product defect, we have to assess, is this really a discussion because they can't pay us, which is a ECL, which is a bad debt expense, or is this a genuine price concession? Because if it's a price concession, it goes against revenue. If it's a credit concession, it does not go against revenue. So in some businesses, this is more difficult. Do you have this problem at all with your clients, to split these two?
Not really.
No?
What if there are discounts to pay early?
That's fine. That's different.
That would again be netted off from revenue, right?
Correct.
That won't go to ECL.
That goes to revenue. That goes to...
That discount is restricting you from making the payment.
Say that again, please.
You said earlier, you said that if a discount is restricting an individual from making a payment, that was a tricky figure. So that discount should go to the ECL portion.
Correct. So you're late, you're having financial problems, my credit control calls you, let's settle this.
That discount was that law, that credit was this.
What I'm saying is, at initiation, if there is a discount, if someone
I
pays
think
He is asking about early payment discount.
A standard early payment discount, that's against revenue. Usually this is when they're late and you're calling to chase the money, and sometimes you'll offer a client a discount because they're in a financial bind. That doesn't go against revenue. That's the difference there.
Can the percentage of the current category be equal to 0?
Say that again?
Can the percentage of current category be equal to 0?
No. Well, it could be small, but it shouldn't be 0. What the standard says is there's a default risk on everything. It might be insignificant, but it can't be 0.
This is what's different from the previous time.
Yeah. I mean, if a AAA instrument, the default rate might be 0.000001%, but it can't be 0. Then you could say it's immaterial. Then you could round it down to 0, maybe, but you can't assume it's 0. So the standard.
Same goes for government bonds as well.
Well, that's a messy question.
Assume in this market government bonds do not carry it.
What we do in the U.S. is we assume that government bonds are risk-free. If you're in Europe, it depends on